Welcome to AM Best's webinar on global reinsurance, transforming reinsurance, current trends, and future impacts. I'm Lee McDonald. Perhaps the song Anticipation could be the theme music for the reinsurance industry this year. Despite early optimism, the market is certainly making the sector wait with no clear signs of widespread hardening. We'll be discussing that and other significant issues facing the reinsurance industry. We have a terrific panel here today, and I anticipate we'll have an outstanding presentation. We will likely mention the subject of financial strength ratings. Full explanation of AM Best ratings is found at www.ambest.com/terms.html. And finally, opinions expressed by the panelists are theirs alone and do not necessarily reflect the opinion of AM Best. Let's meet our panel. We'll start at the furthest from me right here is Scott Mangan. Welcome, Scott. If you could just give your title and just talk about your role at AM Best.
I'm Associate Director. I work on the reinsurance team with Bob and been with AM Best for over 10 years.
Great. And Bob DeRose, welcome.
Thank you, Lee. Bob DeRose. I'm a Senior Director here at AM Best, and I work with a group of analysts that follow the global reinsurance industry.
Okay. And John Doucette with Everest Re. John, your title and your role?
Good morning. Thanks for having me here. John Doucette. I am President and Chief Executive Officer of the reinsurance operations at Everest Re.
Okay, and Greg Richardson from Trans Re, welcome.
Good
And
morning.
your title and your role?
I'm the Chief Risk Officer at Trans Re, based in New York.
Okay, great. Well, thank you for all joining us. Let's get started here. We'll start at the top here. Obviously, the old saying is about the only thing that remains constant in change. Of course, that's true in risk and insurance, reinsurance. Let's look at the next 5 years. Perhaps we'll start with you, Bob. From your perspective, and as we go through our panelists, what are the changes and factors that you see have the greatest potential to impact the overall market for the next 5 years?
Yeah, well, I think that it's true that change is constant, and I think that the reinsurance sector has, really continuously evolved. It does seem to me that the pace of change is picking up over the past, I'll say, 3 to 5 years. I think it's driven by a number of things. I think at the onset it was the introduction or the increased participation from alternative capital that certainly started to have a greater impact and is having a greater impact on the market dynamics today than it did previously. I see that as a trend that's going to continue. And then there's a lot of talk about innovation, but it's not just innovation in terms of technology, it's innovation in terms of product and distribution. I think that, reinsurers are definitely striving to find ways to get closer to the risk. This is also true of the alternative capital as well. People want to try to get as close as they can to the client to try to own it, so to speak, so that they have a consistent and stable source of business opportunities. And then there's the changing landscape in terms of products and business opportunities with regard to structures. I think that we're seeing new unique risks that are presenting themselves, and I think the reinsurance market is responding to those. And there are some examples. We'll get into them, I'm sure, as we through the day. Cyber, flood, mortgage is another relatively new class of business, and then new geographies as well. I think that reinsurers are definitely looking to expand geographically. So those are many of the things that are on the horizon in terms of change going forward.
Greg, from your perspective, what are the factors that really are changing things the most, and what are the changes you expect in the next 5 years?
The topic was of constant change, and everybody has the perspective that change is faster than ever before, and I think it's true. But I remember when I first joined the industry as a former management consultant, and we were implementing claim specialization as though that was the newest thing and greatest idea. And I remember meeting an older gentleman who was retiring from the claim department, and he said, "Yep, this is the third time I've been through this process." And he said, in our industry, the pendulum swings. When losses get out of control, we tend to focus on the loss ratio, and when expenses are a problem, we tend to focus on the expense ratio. I think we've been in a period of fairly benign loss activity, despite him and the losses of 2017. But in general, there have not been huge capital events to the balance sheets in the past few years. And I think that's contributed to a sort of a complacency about pricing and the loss ratio, but a lot of focus now on cost, scale, M&A and those sorts of things to improve the operating efficiency. I think we're in a volatile industry. That's what we do. I suspect the things that will change us most will be some unexpected event, as it always seems to be. And then probably problems will emerge on the loss side. People will wake up and the pendulum will swing.
Right. John, same question, a little bit of an addition to that. And in addition to the factors we've mentioned, and obviously highlight the ones that are important to you, anything that people aren't thinking about at this point?
Sure, I do agree with the panelists that the pace of change will continue to accelerate. But I do think that something that hadn't been covered yet is that the hurdle for acceptable results continues to be increased. What do I mean by that? I mean that when you think of regulations, whether for publicly traded companies, rated companies, you think of regulators around the world, and just the impact and the cost of the regulations and the minimum requirements and the infrastructure that's required to support and execute successfully within those regulations, I think is going to continue to be a challenge. All the time while you have the capital coming into our space, the competition coming from various forms, when you have some of our competitors evolving, when you have some of our customers changing their buying habits, when you have margin compression both on the insurance and the reinsurance side, and the long-term price of risk continues to be under pressure. So you have the twofold margin pressure at the same time that there's regulatory hurdles that make it harder to compete. And I think this is just going to highlight that there's going to be winners and losers going forward. You have to have operational efficiency. A company to succeed has to have operational efficiency, expense efficiency, access to profitable business, access to alternative capital, and relevance in the market in whatever form they participate in, whether it's domestically, internationally. They have to be relevant and solving their clients' and brokers' issues.
Okay. Scott, let's go to alternative capital at this point. First, what are we reporting in terms of the presence and the amount of alternative capital in the reinsurance market these days? And the second question, of course, is it going where it's always been going, or is it going to new places?
I think the number's somewhere around just below or at about 100 billion. I think that it will continue to be very prevalent in the property catastrophe space. I think there's also been, maybe not looking at the fact that alternative capital or the capital markets have been in, the life insurance space for some time now, and they don't have necessarily an aversion to longer tail classes of business. It seems to really depend on modelability and the availability of data. And so if those two elements are there and present, I think that we'll see that this third party or convergence capital, whatever it's particularly called at whatever time, will look to explore those places. I don't know how quickly it will happen, but I think there's certainly opportunities in those spaces.
John, how would you ballpark that? Do you think ILS and alternative capital is going to go beyond property cat, or is it just discussion?
So it's an interesting question. I think that the alternative capital is here to stay, and I think they passed an interesting test at going into January 2018 after the Q3 and Q4 events. So I think that's something we all have to think about. So in terms of whether they're going to go beyond property catastrophe, I think they're going to struggle for doing it in size and scale and truly impacting our industry. There's a lot of different reasons for that. The modeling, basically the margin, the duration of the risk, those don't lend themselves. The lack of kind of standard analysis, less margin as a percentage of premium than property catastrophe, and the duration of a lot of the risks, I think, are really going to make it harder to get into those spaces. And sticking with the regulatory theme from before, trying to operate on the insurance side, I think will also, the alternative capital will struggle because of the 50-state regulation system that we have in the U.S. and other similar jurisdictions. I think there will always be a place for rated paper, rated insurance companies, rated reinsurance companies. Somebody has to access the risk, somebody has to underwrite the risk, and somebody has to pay the claims. The question is, what's the capital structure that's behind that?
I mean, that's very interesting to bring that up. And the thought that comes to mind is that, this is where partnership between traditional reinsurers and alternative capital can play a role. The traditional reinsurers have the rated balance sheet, can access the risk, the distribution's in place, the underwriting capability. Whether or not they can attract alternative capital to back some of this longer-tailed exposure, maybe there's some type of a structure where you can cut it off at some point in time once the tail is matured and the losses are relatively known, that it goes back to the rated paper, so to speak, from the alternative paper. I think that holds a lot of potential for the future, and it is a way that traditional reinsurers can reduce their cost of capital over the long term, earn non-risk fees, service revenue, which also will lend stability to their operating performance over the longer term. So I don't know what, no one has a crystal ball and no one can really tell what the future holds, but I do think that it has a lot of possibilities and potential for that type of partnership going forward.
And I think you have spot on the word. I think partnership. I think having a combination of alternative capital with potentially a lower cost of capital, different types of investors, different investment horizons and expectations, with equity capital backing traditional reinsurers and insurers. And I think the partnership where the traditional insurers and reinsurers bring the underwriting expertise, the claims expertise, and the distribution to the equation, I think the combination can be interesting.
Greg, just to follow up on that, when I was listening to John's answer, it sort of heard almost a soft ceiling in terms of how far alternative capital could go in reinsurance. What do you think?
I agree with John. I think that the impact of third-party capital is undeniable, and it's profound. I think it's driving pricing for peak cat risk. I agree with John that I think the powerful economics that have driven third-party capital into property cat, the modelability of it, the transparency of it, the lack of correlation with investment returns, those forces are enormously powerful in cat, a very capital-intensive line of business. Casualty, of course, is, but different sets of dynamics. There it has a lot more to do with float and other issues which are, and it's less modelable, less transparent risk. So I think cat risk is the place that it will be the most prominent. I don't expect, as John says, it to be as easy of a penetration in other lines of business. I do think that we're seeing a sort of a maturation of that penetration. If you look at the S-curve, I don't think that third-party capital will take over all of cat risk. I think it's beginning to mature, and I think if you saw in 2017, an enormous amount of risk and loss was absorbed by third-party capital. So I'm a little bit seeing a sort of a soft landing. I think we've shown, as John and Bob said, there's a partnership there, and I think we're finding that effective partnership, that reinsurers partnering with third-party capital is actually a very effective business model. I think it works well.
Okay. We're joined by Jonathan Kent. He's with the Royal Gazette, and he'll have a question about the Bermuda market.
With regard to U.S. tax reform, are you seeing any resulting changes in the Bermuda insurance and reinsurance market? And do you believe that the island has lost any of its attractiveness as a market hub?
Greg, perhaps we'll start with you.
Sure.
A lot of reinsurance being done in Bermuda.
Sure.
Anything changing there?
Well, like John, I've spent a number of years working in the Bermuda market. I think, sure, Bermuda emerged as a dominant market with the idea of tax benefits being a primary driver. But I think the reality is it evolved into a great marketplace for other reasons. It simply became a place where it was very efficient for brokers to do business, a place where there was such a concentration of talent that an enormous amount of innovation went on there. And it's just become a wonderful place to do business. I think another factor is, I wouldn't say it's regulatory light, but I think the regulation, John highlighted this issue, understands that reinsurance is business to business. This is not a product where we are selling a complex product to your grandparents. We're selling a sophisticated product to increasingly sophisticated buyers. And I think the Bermuda regulatory environment recognized that and also cultivated a great marketplace. So I think those strengths persist. That said, bringing U.S. tax rates down from 35 to 21 is very significant. And it does not have to go to zero for that cost advantage to shift in favor of onshore players, because of the cost of operating in Bermuda is also quite high. So without a doubt, it helps onshore tax-paying companies like TransRe. I don't think it will mean the end of Bermuda, though. There's some great strengths there.
Okay.
I agree with that, absolutely. I think that, the way the risk is going to get to the Bermuda balance sheets will probably be different because of the tax situation, but probably more risk will be written directly on Bermuda paper versus going through a quota share mechanism as it had historically. But I think the other interesting development is ILS and alternative capital. I mean, that is Bermuda is a hub for that type of activity. And again, having rated companies, rated paper there alongside alternative capacity, just helps fuel that potential for partnership going forward. And again, everybody goes there to do business, so it is a center for getting business done efficiently. And I don't see that really changing.
Any thoughts, John?
Yeah, I think, and Bob touched on it, I think you got to break it in, the issue into internal and external. And I do think, and we saw a little bit at year end, and I think we'll continue to see how companies that are both onshore and offshore, how they manage risk and premium and capital will evolve. And I think we've already started to see that with some companies. That will continue. I think new structures will potentially come about. So internally, we are seeing change already. I think externally, it's interesting because there is going to be a closing of the gap of the tax differential that companies operating in Bermuda had, the tax advantage that companies in Bermuda had compared to onshore companies. And I think that gap is, especially in an environment of margin compression, could be challenging, could impact the relative returns and therefore the relative attractiveness of a Bermuda company versus other companies. And Bob addressed that maybe more business would be written in Bermuda and directly accessing the business. And that may in fact be the case, and that may be part of the final solution. But of course, as Greg said, there's a higher cost in Bermuda. So that will have kind of the opposite effect of increasing the potential cost of accessing the business in this time where there is, again, a lot of pressure on expenses. So what happens with external third-party business, I think it's too early to tell, but we need to watch that pretty carefully.
Okay. Let's move ahead with the underwriting cycle, or whether there is an underwriting cycle. Just curious, John, start with you. Last year, a lot of storms. Late in the year, people were looking forward to renewals. Some people were disappointed. What did 2017 tell you about the reinsurance underwriting cycle, and looking ahead, what does it mean?
So after one of the worst years of losses, of catastrophe losses on record, there were rates did go up in loss-affected areas, but not nearly as much as it had in prior years where there had been a shortage of capital. And I think that really is the new paradigm that we all have to figure out, where there basically is close to instantaneous capital into our market. And so we need to position both what happens after the loss and what happens, and how do we underwrite what is our strategy before the loss in terms of what works long-term, sustainable, building the franchise, and protecting the franchise when losses happen. So I think it's going to be muted. I think hard markets could be shorter and could be more localized, as we even saw If 1/1, January 1st renewals were disappointing compared to expectations, I'd say that was more true at June 1, and I think that's noteworthy.
Yeah, it's very interesting. And, we went through the January renewals, and I think that there was some disappointment that the market didn't harden as significantly as was hoped. But everybody was looking to June at that point, and then June really, really disappointed. So it's an interesting set of dynamics. I think that there's always a potential for a hard market, but I think what has to happen is there has to be a loss that's really outside of expectation. And I don't think that the series of events that occurred in 17 were really cumulatively they were material, but I don't think any particular event really was outside of expectation. I think there have been some surprises relative to each event, but nothing really significant enough to scare any capital away. And if anything, it brought more capital in, and that served to flatten or take the momentum out of the hardening. And I think that it is a reality that's going to exist over the long term at this point.
If there's any silver lining in this, I think what really we can look to is we talked, both of us were talking about property, basically the property renewals. And on the casualty side, I think it just highlights that there can't be cross-subsidization of the profits from property catastrophe exposures and lines of business into other lines of business. And that may mean that there's a floor and or upward pressure on non-property lines of business that they have to stand on their own. That, frankly, is good for companies that have scale, global distribution, and write most or all lines of property casualty business around the world. So I think it just highlights, again, the differentiation between the stratification of outcomes that are going to exist going forward, that there's going to be a bigger gap between the winners and the losers going forward if companies were completely dependent on post-losses rates going up meaningfully as part of their strategy. I don't think you can do that going forward anymore.
I think that's really what is driving diversification. You don't see niche players anymore, property cat specialists anymore, because I think everybody recognizes you have to be very well diversified across multiple businesses and across multiple forms of distribution in order really to be able to ride out the cycles or the mutation of the cycles going forward. So it's the reality.
Greg, your take, has the cycle been overcome?
I think discerning cycles is a very, very difficult problem right now. I think, first of all, clearly property and casualty operate on different cycles. I think within lines of business, they have their own cycles. European and UK motor has its own cycle depending on the issues that are at play there. And all of this is in the context of the connection between within the financial services industry and investments overall as capital flows in and out of our sector based on alternative returns. And you have to put this in the context. Since the 1980s, we've been on a huge downward trend in interest rates. And I don't think where that goes, anyone knows going forward. I was just listening to Bloomberg this morning, and someone was saying for the next several decades, we're going to have a bear market in bonds, as presumably they're thinking that 30-year downward trend will be replaced with a 30-year upward trend. So I think we really don't know, but I think it's difficult to paint with a broad brush. There's macro cycles driven by macroeconomic forces, and then there's very small idiosyncratic issues that drive lines of business.
That's a good point. Excellent. Yeah, I agree.
Okay. Scott, let's talk about some of the roles that are being played within the industry. And obviously you've got reinsurers, traditional companies, you've got reinsurance intermediaries, you've got capital providers. A lot of blurring of the lines going on these days. Are we at the point now where you're seeing channel conflict or any kind of disruptive activity going on here?
I'm not so much in the reinsurance space. I mean, Greg and John might be able to speak a little bit better on that than I would, but certainly in personal lines, you see maybe the removal of agents and brokers for highly commoditized products. I think the brokers have been very adept at making themselves useful, and particularly for complex commercial lines. I think there will always be a need for an intermediary there. but it might be more along the personal lines.
Okay.
I think there is going to be this constant tug of war, but I guess that's just natural. Everybody is trying to position themselves to survive for the long term. But I do think, when you think about the reinsurance model, I mean, really very, very few pure reinsurers. TransRe might put itself out there as one of the last, purebred, reinsurers, although you do some things, in insurance, and you have affiliates that do insurance. But Everest has, really, I think, both insurance, reinsurance, alternative capital, TransRe does alternative capital as well, trying to find ways to take the cost out, to get closer to the risk and take some of the distribution costs out. I think that there'll always be an agent or a licensed representative, certainly for complex risks on the insurance side, and you're always going to have this reinsurance broker, although, I mean, some reinsurers still have a direct franchise, although I would think we would all concur that that's pretty much shrinking. But the model is going to evolve in order to sustain itself over the long term. We've done some analysis, of reinsurers that have gone into the insurance space, and quite honestly, the insurance model really hasn't been all that profitable.
For all the talk that we have about pressure on the reinsurance segment, I think by and large, it's the reinsurance segments of these hybrid companies that have been providing the vast majority of earnings over time.
Right. So those that have, tried to develop, I mean, they have to become more efficient and better at it. It can be done, but it just goes to prove that it does take time, really, in order to develop and build a really well-diversified, efficient, organization. I don't know if you have any thoughts on it.
Yeah, I think the entire reinsurance value chain from original homeowner, small commercial, going into agents and insurance brokers, to facultative brokers, to fac risks, treaty brokers, treaty reinsurers, retro brokers, retrocessionaires, alternative capital along the way. That entire value chain and value proposition is under pressure. The entire everyone is positioning themselves to succeed in the future. That entire chain is verticalizing, right? And so I do think you are seeing people, alternative capital, trying to jump the chain and come to the primary side. You see MGAs trying to tap directly into alternative capital. You see insurance companies, large and small, trying to figure out how to directly access the capital. And you have reinsurers or reinsurance hybrids that are saying, well, why don't we go out and do more on the alternative capital side? And some of them, such as Everest, are also saying part of our core value proposition is how do we diversify into alternative lines and distribution. One of those that we decided to do is our insurance operation, which we have been spending a lot of time and the team has done a nice job at building that out. So I think it will continue. I think it will accelerate. Basically, the lines will continue to blur. And I think it's more accepted now that everybody potentially could be doing everything. It does create channel conflicts, and I think it's important for each company to figure out how to manage that. How do you talk to your clients if in some case you're competing with them? How do you talk to brokers? How do brokers talk to capital? And I think that it's important that you have a consistent and clear message. This is where we're doing things one way, this is where we're doing things a different way. And I think managing that process is incredibly important. But this verticalization is going to continue, and therefore the blurred lines, the blurriness of the lines is going to continue as well.
Greg, just to put a final point on that, we hear from the biggest of brokers, maybe the top 3, top 6, we know where the capital is, we know how to underwrite. How much of a threat is that to traditional reinsurers?
The brokers know how to underwrite.
Yeah, I was going to say.
Well, at least we know how to gauge the risk.
Listen, I don't
know how to model the risk.
I think being a reinsurance broker is, I think, is one of the toughest jobs. You have to know what the risk looks like and how it's valued by the buyer as well as by the seller. So no question, there's an enormous talent and expertise there. But in the end, it isn't about being smart. It's about making the right decisions, owning the risk, the accountability, the business processes to control and manage that risk. And that's what a reinsurance does. And so, sure, I mean, you could take the people that are working as brokers and put them in reinsurance companies, and many have made that switch.
Sure.
But in the end, a broker has a very specific role, and it's a very valuable role, and reinsurers have a role, and those roles are very clear. So I don't see that as a threat per se.
Okay, thank you. We're going to turn to technology and a question from Mary Mallon with Reinsurance.
How do you think ReinsurTech, and excuse me that word, will change the reinsurance landscape in the next 5 years?
Bob, why don't we start with you? Obviously, you hear from a lot of companies. Technology is the buzzword the past year, InsurTech for sure. Is that going to have as much an impact in reinsurance as people seem to foresee in general insurance?
It's funny because Greg and I had a conversation about this a while ago, maybe a month or so ago, and you know, I don't see InsurTech or ReinsurTech really having that significant an impact on the reinsurance model. I think that technology is embraced by reinsurers, and I think that they're using it effectively to make their internal processes as efficient as they can. And I think that they recognize that they have to stay abreast of technology in order to continue to remain, you know, an efficient and optimally running, you know, enterprise. But I don't think that that's going to change the landscape by any means. I mean, you know, there are a number of players like, you know, you hear Munich and Swiss trying to find ways to, again, sponsor or spur InsurTech to help the primary companies, to help their clients, you know, improve their distribution capability. And that by doing that, hopefully they build or forge a stronger relationship with that client, and it perpetuates business over the long term. But it doesn't change the reinsurance model, and I don't think it's going to lead to consolidation within the reinsurance space per se. I think it's just a way of them, you know, trying to help their client base take some of the cost out, you know, and thereby, you know, improve their position with those clients.
I would agree. I think that it really isn't it is not a direct impact on reinsurance, but it clearly could be a meaningful indirect impact on reinsurance. And I think we need to watch very carefully what is driving successes and challenges for our clients. And to the extent that for a while the reinsurance has been under threat and pressure from the alternative capital, and now the insurance industry is going to be under pressure potentially, because taking the costs out is the positive side, but if that is an attack on the traditional insurance model, then that's going to impact our clients. And I think it's very, very important for the reinsurance industry to watch what is happening to our insurance clients and the distribution around their access to the business. And I think we need to watch that very carefully so we don't wake up one day and realize that we don't have customers.
Greg, any thoughts on the buzz around InsurTech and what it means to reinsurers?
I think I agree with the themes here. I think the InsurTech as respects reinsurance has been going on for 30 years. I think I was recently on a panel in Italy with, and one of the guys was a technologist working for Google that was on the original team that invented VisiCalc, which was the predecessor of Lotus 123, and of course now everybody uses Excel. I mean, think about the revolution that created, the spreadsheet technology. That, for reinsurance, that was not disruptive per se, but absolutely revolutionary. It set the stage for bespoke analyses, Monte Carlo simulation, all of DFA, which is morphed into economic capital modeling, the sophistication around cat modeling and portfolio economic analysis, which drives cat pricing today. I mean, that revolution's been going on for 30 years. I think it's a slow, gradual evolution around data analytics is where we'll see it. I was also on a panel with a dean of the Columbia Business School, and he says their students no longer are just required to understand Excel. They have to be proficient in a program called Python. Okay. So this is AI, neural network, sophisticated big data analytics that now MBAs are going to be expected to learn. So this is an evolution. It isn't just now. It's been going on for 30 years. I think the bigger issues around InsurTech have to do with networks and the internet, and we're talking there, scale, network economics, high volumes, commoditized transactions. Obviously, the potential there is huge, and And I think the reinsurers will have to be agile and position themselves to respond to that. But we're in an industry which is used to that. And absent John's concerning comments about regulation, which creates more friction and fixed costs, in general, reinsurance is a very nimble industry which can react to change very quickly.
I'm glad to hear that comment on Python. My high school sons have been taking Python for the last several years. So.
Great. I'm still with VisiCalc. So, but John, let's change the topic a little bit toward. We get to a lot of insurance events. We talk to a lot of reinsurers and insurers, and one of the things that's been on their minds for the past year and a half probably is the idea of product innovation. That there's business out there to be had that you just don't have the products for yet, or people are coming up with the products. And through that, they're going to close the insurance gap. There are things that are not insured that ought to be insured, and reinsurers and insurers are going to do that. Where is that, and what do you see as the things that pretty soon we'll see insured that we're not seeing insured today, or at least have the potential?
Yeah, so I think the insurance gap exists because basically the economic losses are a lot larger than the insured losses, insured or reinsured losses. And I think that's an interesting point. And I think there's a couple of things that could drive closing the gap. One of which is the relative price of risk. To the extent that the relative price of risk has come down, that makes the insurance and reinsurance value proposition more attractive. So that alone, so I would argue the innovation there is new forms of capital coming into the system, which is therefore lowering the overall cost of the capital, and that could make potentially the insured part of the economic loss be larger and help close the gap. So that would be the first thing. I also see more, and I think this is kind of continues to be a hangover of the 2008 financial crisis, that we've seen banks and similar financial institutions retreat, and I think there's also been a gap there that I think the reinsurers have been able to step in. Is that closing the gap, the insurance gap, or is that driving innovation into new growth areas that insurers and reinsurers hadn't been in for a long time? I think there are innovations happening there as well, and I think we'll continue to see that in the mortgage, credit, structured finance areas. I think we'll continue to see that, and I think the banks are under a lot of regulatory pressure as well to basically stay within their real core competency, and a lot of these other things were kind of on the side, were side businesses, not the core businesses that they were doing. And I think there's a lot of potential innovation and product development that could happen there as well.
Greg, where do you see reinsurers and insurers pushing back the risk frontier, claiming new areas of exposure?
I think, when people think about the insurance gap, we tend to think about large catastrophes where there's uninsureds, or just, as John says, the economic loss is 2 or more times the insured loss. One would like to think that economics rules, that as the price of cat risk has come down and become much more affordable, and it's not merely the price, it's now, I think we can probably say, the predictability of the price. I mean, it's not going to be so volatile. So it's a more stable, the value proposition in some sense is improved. One would expect an elastic demand response, right? If the price goes down, why doesn't demand grow dramatically? And I think one of the real reasons is institutional barriers. People don't buy earthquake protection in California because they're not required to by the banks. In Japan and in other parts of the world, earthquake reinsurance insurance is in effect rationed, because the sense is if you made it required, the cost would be so high that it would be unaffordable. So in some sense, it's rationed. And these barriers are the ones that need to be overcome. I think in Florida, the regulatory environment, where because the cost was prohibitively expensive, it was deemed okay to have an insurance company that's capitalized to a 1 in 100 level, which is really an uncomfortably risky level of risk, considering that 100 contemplates the fact that most hurricanes don't actually hit Florida. So it's I think what we really need to push for, particularly in the property space, is enlightened regulatory and institutional change that says that these risks should more properly be insured in the first place and therefore create more demand for reinsurance.
Okay. Scott, as you conversations with reinsurers, what are the risks that you're hearing about that we didn't used to hear about that they're contemplating covering?
I mean, you hear some things about things like European pension liability and things more in the financial sector than traditional reinsurers are. I mean, there's always been the credit and surety type lines, but you're seeing some mentions of things like that. I also think emerging markets are a major driver. I think you see the gap between insured and economic losses more dramatic in emerging markets because you have significantly lower insurance penetration there. And that's really where insurance and reinsurance can have a meaningful effect on people's day-to-day lives and improve conditions overall too. So I think it's a mix of sort of the more complex financial risks and also bringing existing products to markets that don't really have them right now.
Right. So part of that may be innovation in the distribution, and either innovation in the distribution and/or lowering the cost of the distribution, both of which could help increase the insurance penetration.
And then you run into the issues that you had mentioned before about regulatory issues, and you just can't go to an emerging market and say, "I have this great product, here it is." There's a lot of regulatory hurdles and getting into those markets that are challenging. So there's a lot of different ways to do it.
But in some ways, that's back to what Bob raised originally, which is the partnership model, right? So to the extent whether it's I think the insurtech space, I think, has found a lot of them. Well, we'll just set up an insurance company, and that hasn't really worked out so well for a lot of them. And I think now the more nuanced and refined thought is, well, we're really good at some things. Insurance companies, by the way, are pretty good at some things too. And the partnership model and so I do think these are opportunities in emerging markets for insurers and reinsurers to find some of these products, find some of these new methods for distribution, hopefully lowering the expense structure that exists within the distribution and underwriting and managing the capital. And then that will allow, in the partnership of different alternative capital, insurtech, married with traditional rated reinsurance companies, insurance companies, will result in a better value proposition for the customers. And frankly, more opportunity for reinsurers like us.
Okay, and now we'd like to hear from Steve Evans at Artemis.
Given property catastrophe risks do not always meet reinsurers' required returns for their cost of capital anymore, has it now become essential that global players utilize a second balance sheet consisting of third-party capital?
Thank you, Steve. Of course, the question was about secondary balance sheets, things like that. Bob, what's your take from what you're hearing? Is that a larger issue or a larger issue at all?
I think it is an issue, and I think that reinsurers are increasingly embracing utilization of alternative capital, either through a sidecar mechanism or through some type of retrocessional capacity. I think that they recognize that investors' expectations may be very different than the traditional investors of the reinsurance franchise. So they can try to place the risk with the capital that has the appropriate return hurdles. And I think if I think of the spectrum of rated reinsurers, it's hard to think of one that really doesn't have some type of access to alternative or non-traditional capital. So it's definitely there, and I think it's going to be there for a long time. I think we touched on this earlier in our discussions. I don't see that changing, and I see that increasing going forward.
John, any thoughts on that?
Yeah, I agree with what you said, and I think it's interesting again to break the reinsurance market into the top global leading reinsurers and then some of the smaller ones. And I think I'd say all of the large global reinsurers have embraced this in some form. The form of it varies, the scope of it varies, the product offering varies, but basically all of the global reinsurers have in some form addressed this. And then a lot of the smaller reinsurers, I think, are frankly struggling. Some of them have embraced it, and some of them haven't yet, because there also is a scale required and an investment and resource allocation required to do that, and maybe they don't have enough premium to support that. So I think that just highlights again that there's going to be an increased stratification of the futures of the reinsurance industry between the winners and the losers.
I mean, I think some of the smaller players, we won't name them, have tried. They've set up small structures, but again, they're very, very small. And I do think that relevance plays a role in terms of attracting the capital.
Right.
So it is going to, probably lead to further consolidation, because obviously, if you're to remain competitive, you have to be able to access various forms of capital across the cost structure. And if you can't do that, you're probably going to render yourself, non-existent going forward.
Okay. Greg, I'd like to move it into the area of cessions and cession rates. We're hearing that they're up for many different lines. Now, is that a factor of rates and terms for reinsurance, or is that a factor of the risks that are being ceded? Cession rates by primaries to reinsurers.
Session rates,
or
pricing.
Or the business that's going to reinsurers from insurers.
Ceding more.
Yes, they're ceding more.
I think that trends have changed. I think the buyers are more sophisticated. That trend continues. I think often they will retain more and manage risk and on their own balance sheet. But I think as reinsurance has become competitive, often will buy higher up. And I think there's more of an awareness of tail risk. I think AM Best stochastic BCAR, at least in its original launch, had drew a lot of attention to that issue. And I thought it was actually quite enlightened awareness that it's convenient to look at the 1 in 100, it's convenient to look at the 1 in 250, but if you focus exclusively on that, you create some unintended consequences. And I think what AM Best did is highlight the potential flaws in that industry focus. And so I think that's also probably contributed to some changes in behavior.
John, what are you seeing in terms of ceding patterns, and how's that changing?
So we have seen cession rates increase, and that's been highlighted by ours and other large global reinsurers' gross written premium increasing. Ours has increased for the last several years, which isn't an obvious outcome given the superficial comments that the market is soft and things like that. We're seeing opportunities. We're seeing our global clients looking to cede more. Why is that? For the last many years, if you go back starting 8-10 years ago, there was slowly a move to centralizing reinsurance buying and having a central ceded reinsurance department, and globalizing the treaties. And typically globalizing the treaties, and this got more prevalent, say, 3 or 4 years ago, globalizing the treaties means there's a higher retention for all of these, whether it's property or casualty. And that ultimately means they're keeping more risk. Well, I think 2017 showed that the world doesn't work on a pro forma basis, and that there's a lot of volatility. And it was interesting how, while a lot of losses were ceded to the reinsurance industry from the 2017 cat events, there were many global clients, the large global multinational insurers, that did not collect much on their catastrophe programs. And I think that was eye-opening to them. I think they're also ceding more on the casualty lines. And I think part of it, they're looking at the calculus of, is it better to hold it on their own equity capital or lay some of it off, and laying it off to traditional third-party reinsurers. So again, we're seeing they want to trade more with certain reinsurers, and they want to trade with reinsurers that have the scale and relevance and being able to trade with them in property and casualty lines all over the world. And I think that is positioning the larger reinsurers well. I also think, to the extent that you had a very specific to 2017 events, I think to the extent that people had capital issues or concern, or boards concerned about what their post-catastrophe results were, that may increase their view of what the risk, the tail risk, like Greg talked about, is, and that the boards may focus on that they need to manage better and lay off some of their more of their peak zone exposures and tail risk.
I think it's also interesting that we've seen reinsurers buying more reinsurance too from the retro markets, and we've seen a lot of gross PMLs stay flat or tick up a little bit, but on a net basis, it's relatively flat, or in many cases, it's on a downward trend. So I think reinsurers are savvy enough to know that, and normally this is with collateralized players or the capital markets themselves, and they're utilizing maybe some of the pricing dynamics there to safeguard their own balance sheets.
Okay, well, thank you, and we're coming toward the end of our discussion here. Let's finish it up with M&A. Bob, we'll start with you. While back, we've seen some deals, but some people thought we'd see more deals. Where are we in the M&A environment, and what do you think is likely to happen?
I'll take my crystal ball out and give you some forecasts. I think that M&A is going to continue. I think whenever a market is under pricing pressure, as the reinsurance sector is, I think, and we discussed the importance of relevance. I think that you probably are going to see a continuation of M&A, and it's going to be probably driven by the need to remain relevant to the market. So scale and your ability to develop a well-diversified business enterprise. I think that there may have been fewer deals, but I think there actually were some large deals. I mean, the XL-AXA merger is an example of that, and I think that that demonstrates. I think it's kind of interesting. It happened post 17, so I think XL experienced a significant degree of volatility in its underwriting performance, and I think trying to build out and become more efficient, globally, and to have the access to greater levels of capacity, were all reasons that kind of incubated that transaction, and also the ability for XL to maintain its franchise, somewhat separate and distinct from AXA, although I think they will be co-branded. But all of that, played into that type of transaction. So I think that while it's probably going to happen more so amongst the smaller players, it doesn't preclude larger players, also engaging in that type of activity. And again, I think it's driven by the market dynamics. It's a very competitive market. You have to generate reasonable returns for your shareholders. That's becoming increasingly challenging, and trying to find ways to improve, optimize, and better diversify the organization, gain relevance, is all going to factor into that equation.
Okay, John, what's your take? Is the lineup set to change?
Well, I think your first question, or one of the first questions, was we talked about change and the pace of change, and it's accelerating, and I think that applies to the M&A space too. I think with not just the pricing pressure, but with the change in the insurtech, alternative capital, increased regulations, new clients, new competitors, distribution changing, I think all of that mix will result in change. Some of that will be increased M&A.
Greg, your thoughts? What kind of year are we looking at in terms of activity? And
well, I think M&A always comes in flurries and fits and starts, so it's sort of random in when it happens, and they maybe cluster a little bit. But I think it continues. But I think it will slow eventually for a couple of reasons. One is, once you've consolidated down to a few companies, there's not that many targets left, and there has been an enormous amount of consolidation. So that's one factor. I think the other side is there are economies of scale in our business and in reinsurance, but and in some extent you can argue they're increasing largely because of regulation is one of the reasons. It just is, we're an industry which used to be virtually unregulated, and now there's a lot of barriers to entry and exit, and so that creates some incentives for being larger. However, I think we've got to be careful, and I think that's the threat that we all need to think about, and regulators should think long and hard about. The beauty of reinsurance is its agility, the ability to move in and out of market, make a market in very illiquid, opaque risks, and I think one of the real values that the reinsurance market has is, in fact, to price that. Price that through syndication, through a collective effort to say, I'm going to take a risk here, I'm going to make a bet here, but models are imperfect. I don't know what that answer is, but we're going to make a market in that risk. And some of that comes with the value of brokers syndicating risks, of knowing that, you know, I'm not 100% sure about this bet, but I feel a lot more comfortable knowing that John's company or another company is also making that bet. So in fact, the presence of many players in the market actually serves a very valuable role. And I think at some point, if there's too much concentration, you lose some of that essential dynamic of price discovery and risk-taking.
Great. Well, thank you, Greg, John, Bob, Scott. Enjoyable discussion. I'm Lee McDonald with the AM Best Company. We'll have a link to our global reinsurance report below this video. So thank you for joining us.